The token of the NEAR protocol is about to make a very bullish breakout. And that's based on this chart over here. It's based on a backtest, on a simulation of buying and selling the NEAR token in the past. Now that simulation gave us a very nice return versus just buying and holding NEAR. So buying and holding NEAR would have given us this white line over here. Trading according to that strategy would have returned a 33x. So this here is a linear scale when we look at this on a logarithmic scale. So now each horizontal line is a 10x from one another. We can see that the outperformance comes mainly from making money during bear markets. So there's no leverage here. There is no additional risk taking being done. It's simply just timing the market. Should we bet on rising prices or should we bet on falling prices? And you can follow the current trend by optimizing moving averages. So the strategy is very straightforward. We want to buy whenever the price is above the moving averages. So in this case, we would have gotten roughly a 50% gain. And then we want to be selling or even betting on falling prices whenever the price is below the moving average. So in this case, from April of this year to July of this year, we would have bet on the NEAR price going down, and it did go down by 76%. And so currently we are still below the moving average or below both moving averages. But once we close a day above $1.7, this turns bullish again. Now what's so special about these moving averages? We can have different durations here, right? We can take, for example, the 120 day or the 130 day. We can see the longer we make this duration, the further this moving average goes away from the price. And we can take shorter durations, let's say the 50 day. Now the moving average gets really close to the price and we can shorten the duration. The moving average gets closer and closer. And the closer the moving average is, the earlier you would be buying in whenever we turn bullish, and the earlier we would also be selling whenever we turn bearish. But on the other hand, we also have a lot of failed signals, as in fake outs. So you're moving above and below the moving average, potentially buying and selling all the time. But if we've got a longer duration, let's say 150 day, you don't have all of this trading happening and you rather just go with the macro cycle. And this is, I think, the difference between bad technical analysis and good technical analysis. The difference is, are you using an approach that has some weight behind it, that has worked well in the past? And that's why we make these simulations, to determine what's the best duration. And so I've done just that for NEAR. And this is the result. Let's first look at the setup. So the sample starts in October of 2020, goes all the way to today, the 4th of June, 2023. And then we start with an initial capital of $1,000. We don't have any gas fee, so no fixed dollar amount for trading, but we do have an exchange fee, so we can change these kinds of parameters as well, depending on whether or not you're buying and selling on a centralized or decentralized exchange. You can adjust all of those, right? The gas fee becomes relevant in case you don't have a lot of capital and use decentralized exchanges, but let's simply work with those parameters. We can then decide, do we want to only buy whenever the price is above? So that's this case over here, and just be in cash whenever we are below? Or do we also want to bet on falling prices when we are below? So let's say we go only in cash. We don't go short whenever the price is below the moving average. We can still run this backtest. So this is a macro enabled Excel sheet, which can, by the way, also be downloaded at the premium membership. So the link is down below. It's thebitcoinstrader.com. This is where you can get this sheet, where you can also get all kinds of tutorial videos on how to adjust this for other assets. Or if you've got any questions around how to optimize this, or you want to have a specific altcoin backtested by the community, that all can be done in the premium membership. And so now the macro has completely finished. We can see here at column B the duration of the moving average, so in days, because we've got here daily data, and then the annualized return for the simple moving average and for the exponential moving average. And since we don't bet on falling prices now, whenever NEAR is below the moving average, we will now see in the historical chart that there are periods where things simply just go sideways, right? So this is when we are in cash. We still outperform just buying and holding near, but by not as much. We could also do the exact opposite. We would never be buying in any positive way into near. And let's say we are fundamentally long-term bearish on near, then we can simply just try to find good entry points to bet on falling prices. So let's say we never buy near, we only short the token, and we want to find out how much would we have gotten in the past if we shorted the token when the price tended to go down. And so the macro has run. Again, we can find what's the best moving average for this scenario. And then when we look at the backtest, still we outperform buying and holding. But see how we only make money when near tends to fall, right? When it tends to rise, we are simply just in cash. We don't want to be betting on any rising prices because fundamentally we don't like near. But let's say we trust in the backtest and we do both. We bet on rising prices whenever the price is above the moving average, and we bet on falling prices whenever the price is below the moving average. What duration for a moving average here is the best? Should we take the 150 day? Should we take the 100 day? Should we take the 50 day, right? What kind of duration worked the best for near protocol? And let's do exactly that. Let's keep our fees, our initial capital. Let's iterate over the exponential moving average and the simple moving average. And the results here are very interesting. They are different from asset to asset, but usually what we observe is that the simple moving average outperforms the exponential moving average. Now, I don't have an explanation for this, but this is simply just depending on all those different assets that we've backtested. There seems to be some kind of a consistency here, even across different time frames. Now, this is the result when we do both, right? We bet on rising prices whenever we are above, and we bet on falling prices whenever we are below. And since this is compounding, right, this is a logarithmic scale, this really goes to a quite attractive level. Now, what are these durations? Here we go. This is the summary of all of those backtests. So it goes all the way up to the 200 day. And buying and holding during the time period would have actually given us negative performance, minus 44%. That's because the first 200 days we actually cannot trade, because we take those 200 days to simply just get the first value of the moving average of the 200 day. And you want to have the same kind of backtesting window, no matter if you take the 50 day or the 200. So the actual trading happens 200 days after the start of the sample size. And so trading happens beginning with the 1st of May 2021. And this is when near was at $5.51. And currently it's at $1.63. And so when we analyze that performance, that's unfortunately minus 44% per annum for near during this time. But look at the annualized return of those moving averages. Pretty much all of those moving averages outperformed just buying and holding. So there is a real value in that strategy. It almost doesn't matter too much what duration you take. Following the trend seems to make sense. Historically, it pretty much always outperformed just buying and holding. You could have taken the 30 day, you could have taken the 60 day, you could have taken the 150 day or the 200 day. You always would have outperformed buying and holding, even when including trading fees of 0.2%. Now, the best duration for the SMA is the 39 day. The best duration for the EMA is the 24 or 25. They pretty much returned the same. So when we go over here, the EMA, 24, 25, it's the same return. So this is then what we see in this chart over here. So this is near. In red, we see the best EMA. In turquoise, we see the best SMA, the best simple moving average. And so when we close a day above those $1.7, then we turn bullish again. And so you notice maybe that I did not modify any moving average duration here in TradingView. I simply just enabled best simple moving average bands. That's because we have a custom script. So here on thebitcoinstrategy.com, that's the premium membership, we find here at best moving averages a script that you can copy paste into TradingView, and then you get the best moving averages for all kinds of different altcoins. If your altcoin is missing, feel free to simply just request this in the Telegram channel and I will run that backtest for the particular altcoin. But it's nice to have that script because then we can simply just toggle between different altcoins and we directly see, is the asset currently bullish or bearish? This, for example, is currently Ethereum. This is Bitcoin, and let's go back to NEAR. This is NEAR. So the duration does change from asset to asset, which makes sense because assets are traded more actively or less actively. And so when we look at Bitcoin, for example, the best moving average is way slower than it is for Ethereum. And so this is, I think, the fundamental difference between simply just drawing random lines and using data, using a quantitative approach with very fixed rules for trading. You want to take out emotions of trading. You want to figure out, did something work in the past? And if yes, how well did it work in the past? And even though there is no guarantee that it will continue to work in the future, it's the second best thing we have. It's better than just randomly guessing where the price might move. If you have an approach to measure, is current momentum rather bullish or bearish? That's, I think, already a very good step in the right direction. And so here in the statistics library of the premium membership, you can download these Excel sheets, the best moving average for Cardano here, for example, or a backtest for the relative strength indicator. There's also tutorial videos on all of this right here, backtesting with Excel, where to get data, how to include buffers in all of this. These are all videos discussing how to backtest different trading approaches. So personally, I'm not invested in NEAR at the moment. I do wait for some positive momentum, but I do have quite a few interesting positions open that are generating quite consistent alpha. And of course, I can't share them all free here on YouTube, but I sometimes do share my approaches, how to find those directly here on YouTube. So feel free to subscribe. If you want to learn more about premium, feel free to check out this video over here. Looking forward to seeing that video and thanks for watching this one. Bye bye.